Good afternoon and welcome to our weekly webinar. This is a great one. We had record registrations because of these two guys who have, you hear about them in the news a lot and see headlines, and they're here with us at Real Wealth. So I really just can't wait to hear what they have to say, even though we've been on panels as much as recent as last week, but lots can change in a week these days. So we're going to get some updates here. The big overall question is, where is the housing market headed? But we're also going to talk about where is real estate headed, and of course there's many asset classes, and we'll kind of go over some of those as well. So we have been doing regular webinars, and looks like we lost Rick, but I'm sure he will come back on. We have been doing regular webinars because things are changing so much. We really want to be on top of it. So that's what we've been doing. And tomorrow's is a focus on Birmingham and how that market is going, specifically with the property management team that we've been referring people to understand how May has gone for them. That's always the big question. So we've got the big data guys here, but then we also, focus in on little submarkets and how certain property managers are doing based on the assets that they manage, which are, very specific in many cases. You can tune in. You probably already, if you got this email, you'll get an email for that will show you how to log in. And so now, again, a disclaimer, I won't read it out. You can read it yourself. It's just enough to say that we are giving you our opinions. We'll be giving you some data that is, well, Daren, I would say that's somewhat factual. I mean, we do our, the data companies do their best to gather data. It's always it's a work in progress, but we're giving data and opinions. So just know that take what works for you and leave the rest, but do not rely on any opinions that we have for your investing choices. Just use it as part of your due diligence, and always run any purchase by a CPA first. I cannot emphasize the importance of that enough, because the funds that you use will be treated differently depending on, again, which funds you use, whether it's from an IRA or 1031 exchange or cash or whatever, even a refi on your house, a cash out refi. So always run it by your CPA first before purchasing real estate, because these are big investments and they're long term. It's not like you can be in and out with your now with your cell phone and buy stock and get out of a stock in minutes. It doesn't work that way in real estate. So you really got to go to the experts to get your advice. All right. Well, I will go to Daren first because we lost Rick for a minute. Hopefully he comes back on.
He'll be back.
He'll be back.
I'm sure.
Yeah, he probably had an emergency. So Daren, I've known Daren Blomquist for years now. He's been on the Real Wealth show many times, and we've been on similar network, television and radio, giving updates on the real estate market. So he is the vice president of market economics, and analyzes and forecasts complex macro and microeconomic data trends within the marketplace. It's incredibly useful to real estate investors. We're so grateful for the work that you've done that really didn't exist when I started in this industry. So to bring people like you along to help us understand what's going on is it's worth so much. And lots of people listen to you, Daren. You've written reports and analysis. It's been cited by thousands of media outlets. You know how to get the word out there. And again, so important, because journalists have tried, but they don't have the background that you do in real estate. So that's wonderful.
Thanks. Yeah, it's awesome to be here.
Yeah, so thanks for being here. And Rick, glad to have you back.
I am now here courtesy of a hotspot on my cell phone, so I'm hoping this all hangs together. We're having some internet issues.
I completely understand, and if you disappear again, I have a feeling Daren and I can do some talking while you're gone.
No doubt.
I know what Rick would say if he were here. So
exactly, it's perfect for him. So Rick Sharga, I'm sure many of you have heard of him. If you haven't, you should have. He's been an accomplished executive with over 25 years experience in consumer and B2B marketing. He's formerly an executive VP at Carrington Mortgage Holdings, so we're going to be asking a lot of mortgage questions. Previously, the chief marketing officer of 10X, which was also auction. No, what? Yes, auction. Yes, a part of auction.com. And then a regular guest on CNBC and CBS and NBC and all kinds of media that often we are on together. So, so honored to have both of you here, Daren and Rick. Thank you.
Thanks for having us.
Thank you, Kathy.
Let's start with, we'll be taking questions from the audience for sure. You know how to do that on the little chat area. But first, I want to jump in and let's start with something you said earlier, Rick, about the MBA information, recent information. That's, again, explain what the MBA is and what you just learned.
Sure. The Mortgage Bankers Association, MBA, publishes reports regularly on a variety of topics that are mortgage related, obviously. Great source of information on foreclosures and delinquencies. But this morning's report was on mortgage applications. And while the refi volume was a little bit lower than it was the previous week, the purchase application numbers rose by about 6% compared to a week ago and are actually within 1.5% of where purchase applications were last year when we weren't even thinking about a COVID-19 pandemic. So whether that's a temporary blip because pent-up demand from buyers all came together at once, or whether it really should be a suggestion that the spring and summer housing markets will be a little healthier than we feared, the number itself is pretty encouraging.
Well, and low interest rates too must have some kind of impact.
I was talking to a lender this morning who is now routinely offering interest rates below 3% on 30-year fixed rate loans. Wow. With about a point to pay to closing. But anywhere from 2.5 to 2.9% depending on the borrower. So and he doesn't see that going away anytime soon. So it's a great time to be a buyer if you can get a loan and if you can find a house to buy. And that will be the catch for a lot of people in this market, is that inventory actually shrank faster than demand did. So I think we're still going to see a very tight market from that perspective.
Yeah, I'd just jump in there with I've been looking at the MLS data that we have access to on a weekly basis as opposed to monthly basis these days, given all that's going on. And that's exactly what it's showing, is that inventory has started to come back up a little bit. It's still down 38% year over year in the most recent week I looked at, which is, I think, the second week of May. But it was down as much as 52% at the bottom. So it's rebounding a little bit, but you're still 38% below what we were a year ago in terms of just sheer number of properties listed for sale. And so that is helping to keep things looking good, I guess. And certainly the demand there seems to be stronger than the supply, and so, if that makes sense, and so you do have prices had continued to go up. Now there was a little blip, and I am curious. I mean, in the last week of April, we did see, just looking at average prices on the MLS at that weekly data, there was a 2% drop in average price from a year ago. But other than that 1 week, we have seen average prices this year consistently higher than prices last year, and the scarcity of supply is certainly helping with that situation.
Yeah, when I was looking at data from First American Data Tree, we were seeing prices steadily increase through January and February, and even through March, when home sales were considerably weaker than they would have been in a normal March. We saw home prices going up by as much as 5%. I think where we're going to see blips are probably in certain markets and certain price tiers. I think it's much more likely that we'll see some price softening at the high end of the market, where we still have a lot of supply available and it's more of a discretionary purchase than we will at the low end. And again, anecdotally, what I'm hearing in recent weeks is that as entry-level inventory hits the market, you're starting to see multiple bids on those kind of properties again. But it's going to be an interesting year. And Kathy knows the last time we talked, I was talking about the housing market and how it performed during prior pandemics and economic shocks, and virtually every one of those. And Daren, I know you've done research on the housing market in recessions. With the exception of the last recession, just about every time we've been through this, we've seen home prices actually go up from the beginning of the downturn to the end of the downturn. So I wouldn't be surprised if we saw something similar once the dust settles here.
Amazing. Well, Daren, to what do you contribute the that huge lack of supply? I mean, that's a big number.
The sellers are scared of the market, which is understandable.
Mm-hmm.
There's a lot of uncertainty and unknowns, and so if I don't have to sell right now, I want the market to settle down to establish actually some foundation for selling my house. And so I think that initial shock caused a lot of sellers to either not list or take their properties off the market and
Mm-hmm.
say, I want to wait till things calm down. As I said, they're starting to come back, but there's still a lot of uncertainty. And we see that mirrored in the distressed market as well. We have a scarcity of inventory because of the foreclosure moratoriums. And so we're seeing a somewhat similar pattern play out where all of a sudden the foreclosure auctions have gone away and the investors using auction.com, for instance, are gravitating toward the inventory that's still there, which are the bank-owned online REO auctions. And we're seeing those, the bids per asset and other demand drivers increase on those online auctions, given that the foreclosure auctions have gone away. But on the retail market, it's a somewhat similar situation.
Kathy, one thing it's kind of obvious, but just we should probably point it out. A lot of people pulled their homes off the market because they were afraid of having strangers walking through their homes during a pandemic.
Yeah.
And there are other markets where it was just the logical thing to do because the state governor has said essentially shut down all business. And in many of those cases, real estate wasn't considered an essential business, at least not initially. So there was really no reason to have your house listed if nobody was going to be able to come see it and if nobody was going to be able to sell it. And so I think Daren's point from an economic standpoint is exactly right. But I think there were some practical reasons why we saw the numbers go down. And if you look at some of the harder hit markets, you look at New York, you look at Philadelphia, we saw listings drop there by as much as 90% year over year. So there's averages across the country, but you take a look at some of those markets and basically real estate transactions stopped effectively just because of the combination of the virus and the lockdowns that the governors imposed.
So we know that the world just went on pause, and I don't know, I've been thoroughly enjoying it. Having my kid home from college. I mean, she's so much safer here, really, for sure. That is true. But she's doing her online studies, and a lot of things have continued. She's just not at school, so she's actually doing better in school because she's home. A lot of companies are finding that they've found ways to work through this. I mean, we've been busier than ever, which we didn't expect. So as things, we were terrified, right? Nobody knew what this thing was. We needed time to understand it. Now things are starting to thaw out. People are sticking their head out the door, maybe walking outside and saying hi to people and actually going back to work. So, and then these foreclosure moratoriums are starting to, go away, I think, in some places. But when they do you think, and this will be for Daren because he's the auction.com guy, so do you think there'll be a spike at that time when things can open up?
There won't be a spike initially. I don't think it will ramp up because you have two layers of foreclosure prevention and trying to avoid the mistakes of the Great Recession, which is policymakers were really caught off guard. Actually, both Rick and I worked together back at RealtyTrac, and we were putting out releases saying foreclosures are spiking, and we got a lot of pushback that, oh, you're just you're just sensationalizing that because you guys sell foreclosures on your site. And it turned out, anyway, not to digress too much, but a lot of people were caught off guard, and all of a sudden these foreclosures were spiking. A lot of people were saying, oh, it's just a small market correction. It's going to be a soft landing. Anyway, so now we see the pendulum swung in the different direction, where you have a very proactive, very aggressive approach to trying to prevent foreclosures policy-wise very early on. And so you have the moratoriums, which you mentioned, and then the forbearance on top of that. So those two layers will create it looks like the moratoriums will be the first to be lifted, and still the national moratorium imposed by Fannie, Freddie, and FHA, which account for about 60% of the market, 60-70% of the market, those are still in place and were extended. They had gone through May 17th. They were extended through June 30th now. So we're still basically seeing a trickle on our website of those in-person foreclosure auctions happening or being brought to auction. We were doing 1,500 a week, and then it just basically cut off. So it's crazy to see that happening. But as of June 30th, if it's not extended, try to answer your question, I think we'll see a gradual ramp up. But there's no doubt, if just on our site, which accounts for maybe half of all foreclosure auctions, 1,500 a week has been pent up. Now some of that's going into forbearance, some of that's going to come out, and so there will be more inventory down the road. It's just a question of when. And then more like 12 to 18 months down the road is when the forbearance comes off, and you'll see another potential wave of inventory. Maybe wave is too strong of a word, but there's, at the very least, the fact that we are not basically doing no foreclosures right now. Even if it was just a normal market, you do have foreclosures happening even in a great housing market, and so that, at the very least, that pent-up inventory will have to hit at some point.
Well, look, for historical context, Daren knows these numbers as well as anybody. Usually about 1% of loans are in foreclosure, and another 4% or so are in some stage of delinquency, but not yet in foreclosure. Prior to the pandemic, we were running below those historic levels. Probably about 0.5% or 0.6% of loans were in foreclosure. Maybe 3.5% were delinquent but not in foreclosure. And those numbers were actually, I believe, artificially inflated because in the foreclosure case, we had ancient loans in places like New York and Illinois and Florida that probably should have been foreclosed on 5 years ago that were still gradually working their way through the process. Yeah. And in the delinquency side, we really had higher numbers than we should have had because of all the natural disasters over the last few years, and people kind of catching up from those payments. So we're going from a situation where we had below normal levels of foreclosure activity to all of that stopping, as Daren pointed out. And we now have state governments who are looking at laws that would foreclose on foreclosing for the time being. There's a California bill, I forget if it's in the House or the Senate, but it basically puts a ban on any foreclosure activity until 180 days after the pandemic is declared over.
Wow.
So conceivably, you could have 180-day forbearance, followed by another 180-day forbearance, followed by a 180-day moratorium, followed by what usually takes 90 to 120 days in the state of California to let a lender put a borrower into foreclosure. So you're really talking about almost 2 years in that scenario in California before you start seeing any inventory come through. I think, from a kind of public policy standpoint and a socioeconomic standpoint, I agree with Daren that it was really good to see the government get out in front of this and the industry work with the government to get in front of this. Anybody who's tried to service a loan for more than 15 minutes will tell you it's much, much easier to work with a borrower keeping them out of default than it is to fix the problem once they're in default. And I think if you have this year-long forbearance program, the hope is that it gives the overwhelming majority of borrowers enough time to find another job if they've lost theirs due to the pandemic and get back on their feet financially to get restarted. And for those who can't, there's a record level of homeowner equity in the market today, about $6.5 trillion. And the hope is that that extra time will give them the time to figure out they're not going to be able to resurrect their loan at some point. Maybe they can sell the property while they still have equity in it, and walk away with some money in their pocket for a fresh start rather than go through the foreclosure process. So the one other point I'd make, and then I'll shut up so you can actually ask a question, Kathy.
Hey, you guys making this easy for me.
I've been working with the economics team at First American. I've actually been following a lot of their work, and they put out a report this week I thought was very, very compelling in terms of why this downturn may not be as bad for housing as some people predict. And that's that the overwhelming majority of people who've been laid off or whose jobs have been either eliminated or temporarily eliminated aren't homeowners and are renters who probably wouldn't be homeowners anytime soon. You're talking about really a service sector driven downturn where you're talking about travel and tourism jobs, retail, restaurant, people that are making relatively low hourly wages and aren't really home buyers by and large or homeowners by and large.
Mm-hmm.
I think it's the Census Bureau puts out home ownership reports, and it shows that home ownership rates for above median households are about 80%, and for below median households are under 50%. So a lot of the carnage right now is among the renter community. And since you have millions and millions of millennials coming to prime home buying age, I think the demand is still going to be there when we get through this economic downturn.
Wow. So what I'm hearing is probably Daren's not going to be real busy at auction.com in the next year.
There's going to be some fallout. If we go back to normal levels, it's twice as much business for auction.com and twice as many distressed properties for real estate investors. And we will probably go up above that. I don't want people walking around expecting a tsunami of foreclosures like we saw in the Great Recession, because that just doesn't seem likely to happen. But we'll definitely have some fallout. There's no way you lose 36 million jobs and nothing bad happens. I mean, it's inevitable.
Yeah, I mean, we've been running the models off of unemployment, the historical relationship between unemployment rate to seriously delinquent to foreclosure, brought to foreclosure auction. And there's a very strong correlation, as you might imagine. And so, yeah, I mean, when you have record, you look at the graphs and you see this unemployment going up to 15%, which is the highest it's been since the Great Depression. Forget about the Great Recession. You are going to have some impact. And, I would caution against saying, yes, this is going to be another Great Recession, but I would also caution against saying we can get past this with no impact. We're already seeing the impact on the unemployment, and I think that inevitably has to trickle down to distress, and there's going to be some element of folks' jobs that aren't going to come back, some percentage of jobs that aren't going to come back, and more entrenched than just a temporary layoff. So I think the industry did very well. If you look back 3 years ago to the hurricanes in 2017, that's one of the things you can look back to and see forbearance worked very well in that situation, because you had really a short-term shock and a regional shock. It wasn't nationwide. So when the forbearance rates there were in terms of properties that came out of forbearance and went back delinquent, only 5% went back delinquent. So that's very good. And only 1% went to foreclosure auction. I think you're going to be hard pressed to see that type of success with forbearance this time around, because it's not one single natural disaster that impacts just one part of the country. It is bigger than that.
Everything you just said is true, but I'm still going to push back a little bit because everything you just said, everything you just said is based on old models, and One of the things that I know we both learned during the Great Recession is that the models that predicted behavior and predicted, macro or even microeconomic trends all kind of went out the window because we'd never seen that kind of volume of distress and delinquency, and the bad lending practices that got us into that kind of made all the models almost irrelevant. So you're right. Actually, if I were looking at old models and looked at unemployment numbers as they were today, I'd be out predicting not just a tsunami, but a global tsunami. Of universal proportions in terms of distressed properties. But you can't use typical unemployment numbers in this scenario only because, at least on paper, 85 to 90% of the filings have claimed to be temporary in nature. So we don't, in the Great Recession, we only got to 10% only, got to 10% unemployment, but that was permanent unemployment. It was because of a weak economy underpinning all of that. We weren't in that situation this time. And if most of those people, even if it's not 90%, if most of those people do have jobs waiting for them at the end of this, and if most of those people, as I'm surmising, weren't homeowners in the first place, then the effect shouldn't be as bad as what we've seen those models predict historically. The other point I'd make is that the forbearance programs we've been talking about, the people who were predicting the end of the world, basically said we get 25% of borrowers up on those forbearance programs. And my back of the envelope math said that would cost the servicing industry about $90 billion over the course of a year, which would bankrupt the servicing industry. We're seeing the number of people slow down every week who are asking for forbearance. We thought we'd see a little bit of an uptick with May payments coming due, but actually the opposite happened. They went down. So we're at about 8-ish%. No, is that right? Yeah, about 8-ish% of borrowers in the forbearance programs. I would submit that if the problem were as widespread as some of the more negative analyses would make it out to be, we'd see multiples of that number of people in the forbearance programs today. We're not seeing that happen at the moment. If the lockdowns continue indefinitely, we will see the numbers go up, and we'll see the defaults go up eventually too. But the hope is, as businesses start to reopen, we'll see a little bit of relief. Sorry, that was a long-winded response.